This is John Smallwood, and I am back on Money Isn't podcast. I want to, before I jump into today's presentation, I want to say thank you. There is an incredible amount of subscribers at this point of the recording. And when I do these, I am trying to bring as much relevant value and efficiency to your thinking and to the people who are listening to this. And our current clients, people that don't know us, future clients, this is the audience that we are really pushing this information out to. We want to give you as much thinking in the way you want to curate your financial plan, and that you want to have not just one thing, but you want to have multiple things in a financial strategy. And it's the organization of those financial products in a unique way that really make the difference in a plan. It helps reduce taxes, it helps reduce risk, it helps reduce fees, helps reduce costs, helps increase savings, it helps increase the protection, it helps increase the retirement income, and it helps pass more money to your family. If you're not interested in those things, you should hit pause at this moment. And you're still here. Good. So now, as we go through periods of economic conditions and there are changes in tax law, there are changing policies of every country, and our financial plans are subject to the moving and the changing of all of those variables. And that's one of the things that we've been talking about for 30 plus years in the financial services industry, over 35 years in this. The Money Isn't podcast, this is an extension of what it is that I do, right? Money isn't means a lot of different things to different people, right? Money isn't a boat. Money isn't a car. Money isn't a house. Money isn't Bitcoin. Money isn't the stock market. Money isn't cash, right? It's a derivative of all those things. The way I view it, it's what does the money allow you to do, okay? How does it make you live? How do you enjoy your life? And money has energy just like any other thing in life. And if I hoard it, okay, meaning I protect it, I will most likely lose it, right? Or diminish it greatly. If I restrict it, it won't flow. And, one of the things that one of the previous podcasts we were talking about, like an old audio presentation that we had done, and it brought me back to some of the concepts of my foundation of my career, right? And there's part of the economy that makes the economy really, really strong is the idea of, in economics, it's a term called the velocity of money and the money multiplier effect. And the purpose of that, or the essence of that conversation, or the essence of that equation, okay, is that if you have money that is in motion in the economy, meaning people are spending money, and businesses are spending money, consumers are spending money, that means money is moving from one person to the next, in essence, right? One business to the business owner, to the employees, to the suppliers, to the cleaning services, every element of that, right? The more velocity we have in our economy, the more productive the economy is, the more healthy it is. And you think about it from like the term that we had referenced in one of our old thinking or breakthrough thinking is a catalyst for financial freedom, which is an old 1995 podcast. You can see it out there. But we talk about a river, okay? And the flow of a river, okay? And if you dam a river or the river gets blocked in any way, what happens is it loses that flow and it becomes stagnant, and things in it they stop growing and they die off because it loses that flow of water. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. When you think about the economy, that makes sense, right? Money in motion makes a tremendous amount of sense. But when you think about your personal financial plan, most people are like, I don't get that. I don't get how economics applies to my personal wealth. And it's sort of like, if I put money in one vehicle, one financial product, and I let it sit there, and it's there, and I compound it in perpetuity inside that product, it creates a lack because money is not in motion. It requires other things to happen during that time frame, right? It creates additional expenses, additional costs. Some of the examples of that is if I have all my money in a qualified plan and I don't have any liquidity on the outside and I happen to have an oops happen in my financial plan and now I have $15,000 credit card debt and it's at 20%, I have your plan may allow for a withdrawal. It may allow for a loan, but then you're basically taking money out of the stock market and then you got to pay it back within a time frame. And it's just creating like these ripple effects. It's like one thing hits something else, right? So I wanted to take the concept today and say the essence of what you do in your wealth plan revolves around this idea of velocity of money and money multiplier effect. And the healthier your money is the healthier that you have multiple things going on at the same time, that you're doing different financial products and you've coordinated them in a way that one product may produce income rather than taking that income and reinvesting it back in its own self. You might take that income and put it into some other tax structure or some other type of strategy. And what that does is actually reduces taxes over time, which is a good thing. And you might be able to pick up more benefits and more protection with the place that you put that money into. Okay. So, and what I think about always is the level of risk, right? And this is what I wanted to, as I come back to the velocity of money and the money multiplier effect, and I'm talking about this, like, how does this apply to me into what I do? Okay. And we're going to throw up a chart. I pulled down the February 28th, 25 chart. I did not pull down the daily chart that was today when I'm recording this, which might be mid-March. It is actually mid-March. It's the Ides of March. Okay, March 13th, not quite. I think March 15th is actually the Ides, right? That's an old saying from something. So what I wanted to look at is everybody talks about the S&P. Okay, and everybody's talking about the top 10 stocks that are driving 35% of it comprises 30 to 35% of the market at this point. Okay, and I think what's really interesting is if you look at this chart is broken down into a couple different areas, and what I want to focus on first is the weight of the top 10 stocks in the S&P 500, percentage of market capitalization of the S&P 500. So this is like, if you look at any S&P 500 fund, you're going to find that there are 10 stocks that represent anywhere between 30 to 38% of that fund makeup, depending upon whether it's a mutual fund, an ETF. There's multiple different tickers that I can name off. It doesn't really matter what the ticket is. It's the concept that I want you to get, okay? So as of this chart, weight of the top 10 stocks in the S&P, this chart goes back to 1996. And in 1996, the top 10 stocks represented about 18% of the S&P 500. As of February 28th, 2025, the top 10 stocks represent about 36.4% of the market capitalization, which means what is the value of those stocks compared to the rest of the stocks in the S&P 500. So if you're using the S&P 500, there would be 500 stocks minus take 10 out. So you're left with 490 stocks. All right. It represents 36% of the total value of all the stocks. So it's 10 stocks represents 36% of the market valuation. It bottomed out again 14, 15, 16, where that's 2000s, right? 2014, 15, 16, where you're back down around that point of 17, 18% of the total market capitalization. If you look at 2000, which is a really interesting inflection point, right? Because we're here, you're up at 27, 25, 26, 27% of the total market capitalization is in the top 10 stocks. I wish this chart actually showed what the top 10 stocks were at that time versus what they are now, because they are different. They are completely different, right? So as we look at this, do you perceive that the risk of the top 10 stocks would be greater if it represented 15% of the total market capitalization or it represented 36.4% of the total market capitalization. I think that answer is pretty clear. It would be a higher risk. So when you look at 2000, right, 1999, 2000, and it's topping out at 27%, if you recall, because you may not recall, you had the market from 94, 95, 96, 97, 98, 99 on fire, okay, which was led by, everybody knows it as the dot-com bubble or burst, okay? And what you're looking at is the S&P 500 during that time frame, as we got to the top of that, was actually down over a 3-year period, approximately 50%. Now, and I tell this story every single day. We have the presentation that we can provide that shows this information. You can do it on any website. You can, this is not my opinion. This is sort of the strategy of what's happening, right? If I had sitting there in 1999, I'm retiring, and I look back at all the historical market performance, you would see that the S&P for a 20-year period, for a 15-year period, for all those periods, has a really good rate of return, somewhere in the neighborhood of 10 to 12%, depending on the time frame that you look at. And I want you to get the concept, okay? So if I'm sitting there in 1999 and I'm about ready to retire, and I'm doing this back testing in my spreadsheet, there's no reason I can't take out a 5% withdrawal. So I put $500,000 in the S&P 500 in 1999. That's all my money. Assume that for a second. And I'm like, okay, I'm going to retire and I'm going to pull out 5% or $25,000 a year. I'm going to make a slight adjustment for inflation at 3% because I got to go to the grocery store and buy some eggs. Okay. Where would I be today with that strategy? Despite having the last 25 years has been a great rate of return. Looking back to 2000 through now, it's been a great rate of return. But when you look under the hood, how did that return happen? Okay. So if I put the $500,000 in and I'm pulling out 25,000, I went through that 50% downturn over a 3-year period, got into 07, 08, market was coming back up. And then 08, 09, the market's down another 57%. And what happens is to get to 25,000, I've got to sell shares. When the market is down 50%, I got to sell twice as many shares. Why is Warren Buffett a bit multi-billionaire? He's got 100x what he had when he was 56, he's 90 something, right? Is he never sells shares. So as I sell shares in a down market, when the market recovers, I don't have as many shares to recover. So this story ends in about 2013, 2014. The portfolio, that $500,000 beautiful portfolio with me pulling out the 25,000 is down to 23,000. I'm 14 years into retirement and I'm broke. That's risk, okay? That is risk, okay? Because it's not about the product. It's not about the return potential. It's the sequence in which I receive. And as I get that sequence, I can't predict how it's going to happen. So I'm looking at this chart, the top right-hand side of this chart, weighted the top 10 stocks. The risk level of these stocks is pretty darn high at this point, representing 10% of it. So like performance last year, really good. Year to date, as I record this, not so good, right? Because it's part of the process, right? And I'm not saying you shouldn't have this. I'm not saying you shouldn't own this and you should be in some stupid singular product. No, it's not what I'm saying, right? What I'm saying is understand what the risk is and build structures around it to have defense, because everybody needs defense. If you're a football fan, Tom Brady's the GOAT, right? He's considered the best all-time great, right? Michael Jordan, LeBron James in basketball, Steph Curry, right? They all play the game differently, right? But they can't play the game without a supporting cast. You can't have a winning football team without a defense. Like, imagine this. Every Super Bowl that Tom Brady won, he went out there and he played a great offensive structure, but the defense never took the field. That's what we're doing in our wealth plans. We're literally not putting our defense on the field. I see people day in and day out who are phenomenally successful and they have like zero defense. Zero. 20, 30, 40, $50 million, $5 million, $2 million, $3 million, like whatever it is. You've got to have freaking defense. Okay. So my point here is that Now, when you go over and you look at the left-hand side of this chart, which is a really nice chart, it's called PE ratio, which is price to earnings. Take the price of the stock divided by the earnings, and you come up with a number, okay? Of the top 10 stocks, and then the remaining 490 stocks, next 12 months, 1996 through the present. So what you see is if you kind of connect the dots on the two charts, right, which is the same chart, which is different elements of the chart. In 1996, the price to earnings ratio on the S&P was about 14, historically low at that time. And then it went all the way up to 24%, which is historically high. And that's about 2000. The top 10 stocks was about 2022 at the time and extended up to, looks like, close to 42, 41, 42% at that high, depending on the logarithmic scale of this chart. And then they crashed all the way down to the 14s. So that means the price of the stock and the earnings both dropped, and the stock dropped along with it. And then we got all the way down in the 2012s down to like 8s. And people didn't want to buy. People want to buy when the stocks are really high because it feels good. Like I want to get in. And this happened in the pandemic. This happened in the flash crash. That happened in all these different, the Christmas massacre, all these different things, right? That you can look back. People stop buying when the stock market goes down. And it's the exact opposite behavior of what we're supposed to be doing, right? Warren Buffett, I use him as an example because he's the eternal investor. He buys all the way through. Now, certain disclosures right now are saying he's gone to cash. He's getting ready for this. He may have purchased already. Who knows, right? But you're buying, you want to buy low because why is he super wealthy? He's got a lot of shares. He's got a lot of shares. He wouldn't be super wealthy if he didn't have a lot of shares. Well, how do you get shares? You buy them. And the cheaper you buy them, the better off it's going to be. Simple math. It's not rocket science. But as you go forward in this, right, in this chart, PE ratios extended up into the 30s again. They dropped down. The stock market dropped down. We got down into the 20s. And now it's back up at 29. Right now, the current is 27.4, and the average for the top 10 stocks, this is the top 10 stocks, is 20.6 over this 96 through present. The remaining stocks have a price to earning ratio of 19, and the average is 15. So that would mean that both of these are higher than the average. To get an average, you got to have high and you got to have low. Okay. The S&P is 21 and it's about 16. So the S&P looks pretty well valued at this point, right? It's not overvalued, but it might be when you look at the chart. So what my point is that an expected pullback that we might be experiencing in the moment is actually normal and it's actually part of the process. And it's going to happen when you look back at some of the 1969, I think there was like 290 mutual funds, right? We know there's well over 7,000 of them today, plus the ETF market. But like when you look back at these historical market performances, there's just an up, down, sideways, up, down, sideways, up, down, sideways. But the longer term trend is usually up, right? So you have to look at this, and I want to talk about the way they're defining this in this chart is the economic concentration in the S&P, percentage of the S&P metric for fourth quarter 2024. How much R&D are these companies putting in? The top 10 stocks is 37% of the S&P. So these guys are investing, which is a really good thing. So you could look at charts and go, ooh, ugly, scary, run like hell. Or you can look at charts and go, well, research and development, last I checked, usually produces something new. Not always. Is something new good? If I've got free cash flow that represents 20% of the overall, as a percentage of they've got the freest cash flow, they have the most opportunity to acquire and invest in these things. Their sales, their employees, they only have 12% of the employees. So that means they run lean. It's good business, good structure. So I want you to, everything that you look at, you can look at it with, as my father used to say, rose-colored glasses, right? Everything's good, right? Everything's good. Or you can look at it as really dark sunglasses where everything's bad. Or you can kind of look at the math and go, well, there's elements of good and there's elements of bad. And ignoring something, not having exposure to something is really not smart, right? We're in a point where the amount of people that are scared that the world is over is increasing at a rapid rate, which is forcing people to say, go to cash and go do things. And we know that that could make sense depending upon where your money is. But if your money's balanced and you've got multiple different tax structures and different types of asset classes and different types of vehicles and products designed to play a specific role, the odds of your success go up greatly. And the odds of when I have a liquidity event that I cannot predict, or when I say liquidity event, a liquidity need, right, that I can't predict, well, if I have access and availability where I don't have to pay taxes or I don't have to sell something at a tremendous loss, that provides confidence and clarity. Okay. And I wanted to discuss this today because my feeling is that if you're going to be the long-term successful investor, you've got to have the best defense. And how do you know if you have the best defense? It doesn't necessarily, when you look at, I'm going to take some of the top performing sports teams for a second. I'm not going to call the names, but it's like they're successful because they play a really good game of defense. They let up the least amount of points. They have the most steals. They have the most sacks, whatever it is, right? Most interceptions, whatever it is. There's metrics that are there, and it doesn't necessarily mean they're star players, right? There's some of the defenses right now in basketball don't have any star players, and they're playing some of the best defense hands out. Because why? They have great coaches, and they have a great strategy, and the players are actually applying the principles. Okay, so think of your defense as, what is the ideal defense for the game that I'm playing? What is the ideal structures? Now, you and your brother might be business partners. You and your brother might be in completely different businesses. Most likely, you have very different family structures. So your plan is different depending upon who you are. Now, in offense, how do you become the most efficient offense? How do you have the most, do you win the game by 3 points? You're not going to win the game on free throws, but you are. If you're a 50% shooter versus a 90% shooter, you're actually going to make a lot more money. Okay. But you're also going to win games that are down to the wire, 2-3 points, right? So what my point is that you need to look at your plan and you need to break it down into the elements and be really critical. Am I playing the best offense? Who's on my offensive team? Is my offense structured in the best way that it possibly can be? Am I putting money in the right tax structures? Do I have the right elements of growth? Do I have the right investment structure? Do I have the right defense in this plan? And from an investment perspective, and then from a defense perspective, do I have the right trust work? Do I have the right umbrellas? Do I have the right life insurance, the right disability protection? Am I insuring and protecting myself? Am I being efficient with those dollars? And my belief is that a financial plan to get the best outcome has to have maximum protection or maximum defense and maximum offense at the same time. If you're just all offense, at some point you're going to have a problem. If you're just defense, you're never going to build the wealth. It's a careful structure of balance on this. I really want to reach out to everybody here on this podcast today and say, one of the greatest things that you can do in your wealth plan is to have a really good conversation. And most of you know that we run a company called Smallwood Wealth Investment Management, which is a registered investment advisory firm. And we do a full-blown wealth management plan. We call it the Wealth Curve Blueprint. And I'm going to urge you to set up a free, no obligation conversation with one of our qualified advisors and have a conversation about your wealth, your goals, your dreams, your vision, your concerns, and see if what we do is a good fit for what you do. And it's free. There's no obligation. So I would recommend that you do it, because most people that you're talking to the first question they're going to ask you is, how much money do you have to invest? That's not our first question. And it's long down that list. We're really understanding who you are, what your family makeup is, what business are you in, what are your tax burdens, what's your savings rate, what's your debt structure, what's your lifestyle like, now we're going to talk about some assets, got to understand where you are, all these goals and dreams. And then we're going to be talking about defense, right? It's a really good conversation, and I recommend that you take advantage of it now by going to smallwoodwealth.com, signing up for the free conversation, calling the office at 800-797-1000, and getting on the call. Thank you. Have a wonderful day.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.